What a turbulent start to the year.
Yeah, definitely. So semiconductor companies first performed really well thanks to the AI optimism, but then that also had this kind of flip side, basically putting pressure on software companies, fears around how AI might disrupt them. And then towards the end of the quarter, we also had the war in Iran.
There's plenty of drama and we'll come back to these topics later in this video, but let's look at the fund's performance first and in the short and longer periods. In the first quarter, the Sifter Fund return was 0.3%, a modest but still positive result. When we look at longer time periods, which provide a better picture of how Sifter's strategy has performed, we can draw the following conclusions. In last 3-year annualized return has been 12.6%, 5-year 9.7%, and 10-year annualized return 11.4%.
It's good to remember that although Sifter doesn't overperform the global equity index every year, if we look at this longer term graph, which basically covers the whole history of the fund, the 23 years, over that period, Sifter has clearly overperformed the global equity market index, and this overperformance has basically started to kind of emerge from 2018 onwards. There's also other line there, that the bottom one, so that's essentially represents the average return of funds which are similar to Sifter. This is created by Morningstar, this group of funds, but essentially what you can see there is that Sifter has performed that group by even wider margin.
Yeah, that's correct. And also all the returns are after fees.
Yes,
so net returns.
Exactly.
And if we look at the first quarter once again and compare it to the, let's say, global indices, so we can see that there's a clear outperformance for Sifter by 3%. Most of the indices were on negative after the first quarter.
Yes.
And what were the main explanations for that, by the way?
The biggest single explanation was these semiconductor equipment manufacturers. So Sifter has about 20% weight in that subsector, while the global equity index has about 2% weight. So we have clear overweight there. It helped. But then again, there was also this headwind of essentially not being invested in the energy sector. But these differences in weight are just reflect our strategy. So yeah, we find it easier to find these quality companies from, let's say, technology sector or industrial sector rather than energy or, basic materials or sectors like that.
And perhaps one more upside for Sifter was that we are not exposed that much in software companies, which didn't do that well in previous quarter.
Yes, that's right. Our exposure to this semiconductor sector and its subsectors is much larger than our exposure to software companies, and we don't have any of these kind of pure software as a service companies. They when they have something like that, they always have other supporting components.
Yeah, that's correct. Well, how about valuations? What is the valuation level for quality stocks at the moment?
In a way, it's kind of a tough question to answer because definitions on quality are different. But if we look at MSCI's definition for quality stocks and we look at their MSCI World Quality Index, essentially there the quantitative filters are kind of look similar to ours. So it's probably a good benchmark for this question. So, if we look at the quality premium, essentially the extra price that investors are willing to pay for these quality companies relative to the average company on the market, that premium is still at the level where it kind of slumped towards the end of 2024. It has been on a much higher level for most parts of the past few years.
Okay. So valuations are not at the peak, at least.
Peak. Yes, that's
so. If there's a recovery for quality, then it could mean positive things for the quality stocks. Not for all, but at least that's kind of like on general idea.
Yeah, this was indeed the valuation relative to the market average.
Right.
So that's not at the peak.
That's right. That's correct. Let's look at the fund's top 10 holdings and draw a couple of conclusions from there. So we can see that Alphabet is still the biggest holding in the portfolio, mainly due to the nice share price hike in 2025. But then we have Safran. Safran has been there already a couple of years. It's a nice industrial player. We like it a lot. Maybe surprisingly, one could say that Microsoft being a third, even though share price went down in this quarter and already last year. But Microsoft has been one of the biggest holdings for several years. Other observations could be, for example, that over 80% of the Sifter holdings are business-to-business companies, which we prefer over to business to consumer. And roughly 60% of the companies are either technology or industrial companies.
Yeah, yes. And out of these top 10 companies, only one serves customers as kind of a business to customer, Costco essentially.
Yeah, that's correct. So let's look at the allocations, geographical and sector allocations, and what can we take out of that?
So if we look at the biggest sector exposures of Sifter Fund, the biggest exposure is in technology. And it's good to note that the biggest portion of that consists of semiconductor companies of different sorts, so instead of software companies. The second biggest sector exposure is related to industrials. And both of these are clearly in kind of overweight relative to the global equity index, but that just reflects where we find it easier to kind of discover quality companies at reasonable prices. So we have zero weight in energy and zero weight in basic materials.
What is the reason? What is the reason why we don't invest in energy or utilities or similars?
Yeah, well, in the case of utilities, the upside is oftentimes capped in a way that we don't like. In the case of raw materials, well, the raw material prices, they are so difficult to predict that the forecastability of that business over several years is quite poor. With many of these sectors that we avoid, oftentimes the competitive advantages are difficult to pinpoint or probably don't exist in the kind of strength that we would expect. So
we emphasize kind of like a quality compounders, which are able to generate better and bigger earnings year after year. Well, that's interesting. And how about from the geographical point of view?
The biggest exposure is to North America, although that's quite similar to the global equity market as well, so similar weight. What's more interesting is our exposure to Europe, which is almost 3 times higher than for the global equity index. And that just again reflects where we have happened to find attractively priced quality companies. So, in general, valuation levels in Europe have tended to be at slightly lower level compared to North America. So this is the reason here.
Yeah, and maybe it's good to remind that we are a bottom-up equity manager, so we don't have like a macro view, and we don't allocate the equities based on the changes in the macro environment.
Yeah, that's right. Yeah.
All right, let's talk about the biggest contributors in the first quarter. And the top 3 were Applied Materials, BE Semiconductor, and Disco Corporation. So is there something common within these companies?
Yeah, they are those semiconductor equipment manufacturers. So these overall performed really well during the quarter, and also the companies that were in the Sifter portfolio, they performed well. What's basically behind this is just a general optimism around artificial intelligence, but there's a lot of kind of factors to back that optimism. So first of all, the these companies that operate large cloud computing infrastructure, so essentially Alphabet, Amazon, and Meta, for example, they guided about 50 to 100% increase in their capital expenditures for this year relative to last year. So the growth continues clearly. The second supporting factor for this optimism is that there seems to be a the demand for these chips seems to still outstrip the supply. So if we look at the rental prices for AI processors, they increased during Q1, and the memory prices are still at the high level where they soared towards the end of last year. And then finally, if we look at the kind of performance of AI services, well, Anthropic seems to have roughly tripled its revenue in Q1 alone. So lots of growth indicators.
So several tailwinds
Yes.
for these companies, and it seems like a structural positive demand. But are you worried if a company's share price goes up by 30% in a quarter? Is that how do you feel about that?
Yeah, well, even though there are clearly there's clearly strong short-term tailwind, it's still rather difficult to forecast the long-term growth trajectory. So we actually reduced the weight of a lot of these semiconductor companies during the quarter to manage this risk.
So rebalancing,
yeah, to other lines.
Right. Then we also had some detractors, meaning the companies which didn't perform that well in the first quarter: Novo Nordisk, Microsoft, and ADP. Although it's good to mention that Novo holding is very small at the moment, and unlike Microsoft, which is over 6%, what's your take on these?
Yeah, well, out of these three kind of top detractors, Novo is kind of a different case from the rest, because there were clear kind of company-specific issues, because this drug trial for their kind of next-generation weight loss drug, it didn't perform. Their product didn't perform as well as the competitor's product, and this was disappointing. This was Novo's own experiment, kind of own trial, and we were under the impression earlier that these two would be roughly on equal footing. So this just creates a lot of long-term uncertainty for Novo, and well, we reduced that position during Q1 and might sell it entirely. It's definitely under review now, but currently just 1% weight in the portfolio.
But Microsoft and ADP, did they suffer from AI threat or?
Yeah. In the case of these two companies, there was kind of a bigger, broader issue around them, or threat. So, investors are increasingly worried about, for example, AI assistants potentially displacing software, particularly those applications that you and I use as kind of basic digital tools. So, if we look at the share price trajectory of different sectors, the semiconductor companies clearly performed really well during Q1, and it seems like the flip side of that was just the poor performance of software companies. Just two sides of the same phenomenon.
Yeah, it's very clear in this graph. Where you can see the gap widens.
Yeah, quite dramatically.
Right. So AI has been a major discussion point in this quarter, but also already last year, sometimes in positive light, sometimes in negative. So how do you see AI? Is it a threat or opportunity for software companies and SaaS companies?
Yeah, well, it depends on the company. So if a company offers a really narrow set of applications, or just one application that is not very deeply integrated into the IT infrastructure of the corporation that uses it, it's probably more threatened. And but then again, it also matters how critical the software is, and essentially how costly any errors would be. So that might affect the willingness of customers to kind of experiment with more efficient ways to operate it, or potentially bypass the software. The companies that are better positioned are probably the ones that, in addition to applications, also provide the kind of underlying systems, or the kind of background systems. So essentially hold data, or provide the infrastructure, take care of security, or kind of identity management. Basically the kind of building blocks that the applications and AI assistants rely on.
Right.
So if a company has really a strong position in that kind of a broad sense, then they might even benefit from the increased productivity of that platform.
Exactly. So it's about integration and owning the data and how well you are into the company's systems.
Yeah, the criticality of the software and all that.
Yeah.
Yes.
But we did analyze several software companies last year due to the attractive valuation. What was the main reason we didn't invest in those?
Yeah, well, it's the fact that this is a fast-moving topic, and it is rather difficult to precisely predict what is going to happen in the software industry. So we can see the attractive valuation of many software companies or software-related companies. So we looked into Gartner, Dynatrace, Salesforce, but didn't invest because the predictability isn't quite there yet. So it has been a good decision not to invest in them.
Yeah, that's correct.
We can say at least that.
But it's the big unknown is something that we don't like.
Yes. That's a good way to put it. Yeah.
As you already mentioned that we are limited exposed in software companies as a fund, but what's been the negative impact so far?
Yeah, most of the pressure seems to have been concentrated on ADP and Microsoft. Together, they accounted for about 9% of the portfolio at the end of Q1. Microsoft is obviously a bigger part of that, so we can comment on that now. But before I go into that, it's good to mention that indeed neither of these companies have reported anything or guided anything that would clearly indicate that they are suffering some kind of damage from a kind of AI assistance bypassing something or anything like that.
Yeah.
But yeah, in a nutshell, regarding Microsoft, it's difficult to see that AI would be kind of an existential threat. So at least we can say that. So Microsoft offers a lot of applications which kind of create kind of a complex whole that integrates really deeply with the rest of a company's IT infrastructure, and they also have these they also offer that background infrastructure, so user management, security, data storage, all that. So they are quite difficult to replace. I can easily imagine companies that are easier to replace. So and what's also good to note is they have substantial resources themselves to potentially develop winning AI assistants, even though so far the success has been rather limited.
You mean Copilot?
Copilot, yeah. But then again, this is a fast developing area, so they could come up with something far better.
Right. Okay. Anything about ADP to mention, or is it only a victim of this market decline in software companies?
Well, for them, what the stabilizing factors are probably that they offer a lot of kind of human-to-human service on top of the software that they provide, it's but maybe we could say that Microsoft probably has a stronger position relative to this development than ADP.
Yeah. Maybe it's good to say that ADP is in payroll management, so it's a very critical. So it's not the first service that to be disrupted by AI. That you rely your salary.
Yes, that's a good point. So indeed, some of the software is very critical indeed.
Yeah.
So payroll, you probably don't want that to go wrong. So yeah, there are good components there.
Well, let's talk about the portfolio changes in the first quarter. We already know that it was volatile quarter in many ways. But we did invest in one new company, and we also divested one company. Which companies we bought and sold?
We sold Universal Music Group, and we invested in Rational.
But what was the reason to sell Universal Music Group after many beautiful years?
Yeah, I feel like I'm repeating myself, but again, it's artificial intelligence. But in UMG's case, it actually had more of an impact, more of a visible impact, while in the case of software companies, it's more of a kind of expected impact.
Okay, what kind of impacts did you see there?
Well, kind of several warning points. One was that these AI-generated songs broke through to these hit lists over the past 12 months, like at a surprising success. And there was also this kind of tidal wave of AI-generated music hitting these streaming platforms. The third was that some of these market participants like Suno AI, which doesn't respect the intellectual property in a traditional way, started to get a stronger and stronger footing. So yeah, the competitive environment was changing, and then UMG continued to spend a lot of money on acquisitions, which started to look more as kind of, instead of as growth capex, more of a kind of maintenance capex, because they were kind of potentially plug holes in their market position. So that's essentially.
So several headwinds and unknowns that we couldn't hear the message from the UMG management that how they will tackle those challenges.
Yes, yeah, they kind of addressed the topic in every earnings call, but then kind of didn't. So there was a big unknown of how to manage this situation. So the investment case was basically built on the fact that they own the rights to such a broad range of hits that they are essentially an irreplaceable partner for anyone who tries to compete in the fast-growing music streaming business or music subscription business. But then AI kind of fundamentally threatens that case because it can boost the competitiveness of new music relative to this traditional hits decisively, because the tools are incredibly productive and the price is next to nothing, and it's available to everyone. And meanwhile, it was very unclear whether UMG would get kind of a proper compensation for the new music that is created by essentially copying their hits.
Yeah.
So
unclear growth path, even potential disruption.
Yes. Yeah. But yeah, it's So we sold the shares at the turn of January and February at around 20 euros per share, and since then, we know the
Bill Ackman, Pershing Square.
Yes, made an offer.
Yeah, they made an offer, and it was around the same price per share.
Yeah, it was kind of a complex offer, but the day after that announcement, the share did jump indeed, but it was still about slightly below the price at which we sold.
Okay.
And at this point, we would definitely be selling the price.
That's
the share.
Typical exit criteria to us, that whenever there's a merger or that kind of takeover or whatever you call it, so that we typically sell.
Yes, we don't want to wait around and speculate whether this goes through, because it's uncertain. It's very uncertain.
Nevertheless, we received some money, some capital out of UMG, and then we reallocated that money to Rational AG, which is an industrial player in Germany. So could you describe the Rational business and why did we invest in that company? So it's a pretty typical Sifter type kind of leader in a niche. So they have this dominant market share of about 50% in these professional combination ovens. So there are these kind of large ovens in professional kitchens that take about 10 or 20 or 30 trays in them, and the prices start at about 10,000 euros and go all the way to several tens of thousands of euros. And how is the installed base?
Installed base, so they have been the clear leader in this market for decades. So they have built a substantial installed base, and that creates a lot of predictability, because about a third of revenue originates from after sales. Okay. So spare parts and these kind of equipment specific kind of cleaning cartridges that you kind of consumables that you put in there. And
how about growth for the new equipments?
Yeah, it's the volume growth is in the kind of a high mid to high single digit range year over year, that kind of pace. So not stagnant. There's good growth opportunities ahead because in the home market of these kind of combination ovens in Germany, the adoption rate is far higher than in Europe in general, and much higher than in North America. Okay. And you can, as you might expect, these are kind of converging in the way that growth in North America is much above Europe. So that kind of creates a good
positive trend.
Yeah, I guess a good growth runway for
at least. And how about the financial figures?
Yeah, well, gross margin 60%, so really strong gross margin. Operating margin is about 25%. Okay. Returns on invested capital about 30%. And what's probably supporting this is that these ovens are kind of the serviceability and reliability is critically important for the professional kitchens. I mean, any malfunction during the rush hour is just that revenue is then lost quite obviously.
Right.
And the ovens, while they save a lot of labor, they are very well automated for kind of with a program for each tray, regardless of when it went in, and considering all the starting conditions, and it saves a lot of energy. It also saves raw materials due to the better cooking environment. But they are relatively complex. They have relatively complex internals, so you have to be prepared for some kind of malfunction here and there. So a good serviceability is really, really critical. And this company, thanks to their massive installed base, has a really good service network.
Okay.
And to begin with, they are really reliable. They are the pioneer in this industry.
Well, it sounds that you really like it.
Yeah. It's kind of a breath of fresh air because it doesn't have anything to do with AI, and it's still very profitable and growing.
Yeah.
So a leader in a niche. Yeah.
So it sounds that we are going to hear more about this rational business case in a coming quarters. But let's move on to the smaller changes. So we did some rebalancing for the portfolio in the first quarter, meaning that we reduced and increased some position based on valuations, but also based on some risks. So which companies we decided to reduce?
Yeah, we reduced these semiconductor companies mostly. So Lam Research, Applied Materials, and Disco Corporation. So even though they are enjoying a short-term a tailwind, at least over the short term, obviously, the longer-term growth trajectory, as I mentioned, is much more difficult to forecast. The valuations from a historical perspective are kind of elevated already. So we allocated some funds to other companies in the portfolio with a fairly broad diversification. So some to defensive companies like Costco and Deutsche Börse, some to several industrial companies, and also a little bit to Microsoft, because the lower valuation seems to compensate a lot of the risks at least at this point.
Yeah. So interesting moves, and we'll see how they will play out. And now we are ready for the first quarter earnings season. So to see how the companies have performed in the early start of the year, and we will also update our 5-year earnings yield for each and every company. So looking in a longer perspective again.
Yes.
So to sum up, the first quarter reminded us on several important things. Firstly, markets can move a lot in the short term, but over time, high-quality businesses do the work. But secondly, Sifter Fund's outperformance is built on discipline. So what we mean, we don't chase every market story or hype. Instead, we invest in long term, in a predictable, strong businesses where the risk-return profile holds up over the long term. And finally, we see that our portfolio is built on quality, not index. Right now, we continue to see attractive potential in high-quality companies where valuations are reasonable, where growth and earnings expectations are something that we can rely on. Finally, as a friendly reminder, please remember that the information and the examples we have used in this video are only for informational purposes. Those are not any investment advice. We wish you a very good springtime.